was actually surprised at how few Americans there are in the room versus Canadians, but that's wonderful. How many of you watch Thoughtful Money, my program on YouTube? Don't feel bad if you don't. Okay, so about half the room, it seems. First off, thank you all. Oh gosh, there's Isabella, how are you? Oh my gosh, folks, this is the future of commodity investing. I might bring her up a little bit. All right, so I thought I would start with just serving dessert first, right? Trying to give you hopefully the thing that you guys want most from here, which is some actual investments to go consider out of here. This year, I did try to think about what to call this this workshop, and I said, in a year defined by cross currents, how should we invest? As you probably heard in yesterday's macro panel, this is a year, I think, where a lot of trends that we've all been acclimated to over the past bunch of years start actually breaking. I think it's going to be a year of headwinds and tailwinds. This is not just my opinion, it's the sort of the consensus of the many people that I interview on my channel. I think in a year where there's a lot of uncertainty like this, obviously people are saying, well, look, where should I put my money? So what I like about my job is I get to talk to a lot of smart people. And one of the things that I look for as an investor is when people who have different methodologies come to the same conclusion. And when I start seeing a pattern like that, okay, different paths are still arriving at the same destination, I've got a higher degree of confidence that there's some there. So one of the things that I'm hearing a lot from people right now where they see opportunity that is really starting to interest them as an investor is in the oil and gas industry. Yesterday on the stage, you probably heard Amir Andani. He said in his multi-decade career, he's never seen a better setup for commodities. Not a super surprise to hear at a commodity conference like this, but particularly energy. Ronnie Sterfele said the commodity boom follows a progression. Gold goes first, silver follows, and then the biggest price moves he sees coming from here will be in commodities. Specifically, he thinks copper next, but then oil. I just interviewed a couple hours ago for my channel Mark Newton. You might not know that name, but he's the business partner of Tom Lee from Fundstrat, one of the biggest bulls out there. He's a total technical analyst. He's just impartial on what the macro narrative is. He just looks at what the tape says. To him, he says that oil looks like it's just a few months away from a trend breakout from this multi-year kind of doldrums that the sector's been in. And then our very own Rick Rule, who you've heard talk here a fair amount over the past couple of days, I just interviewed him, released an interview with him yesterday that was a deep dive into the oil and gas space. And Rick, I don't want to put too many words in his mouth, but said it's been rare in his multi-decade career in commodities where he's seen a setup this attractive in the oil and gas sector. In terms of timing, it's not necessarily next quarter. Could take a year, could take 2+ years to come into play. But he is very excited about the potential for returns in the space. And while you're waiting, getting paid pretty attractively by these companies. So again, in the spirit of serving dessert first, take out your notebooks if you want to write these down. I'm going to share first, Rick was very kind on my channel to give about 9 or 10 specific company names that he's watching closely right now, so I'll share those with you right now. I'll then follow them by a similar list of names that I've gotten from, if you watch my channel, from Ted Oakley and his team there at Oxbow Advisors, as well as David Hay and his team at Evergreen Covcall. These are some of their top oil and gas picks. And again, folks, this isn't personal financial advice. You're going to have to do your own homework. But if you want to return from this conference with a list of high potential companies to take a look at, that's what I'm trying to give you here. So if you bear with me real quickly, I'm just going to read a whole bunch of names at you. These are the names that Rick mentioned yesterday. These are not necessarily, folks, by the way, I don't want to put words in his mouth. These are not necessarily the top companies that Rick Rule himself has invested in. He's just saying that these are high caliber companies to go take a look at. Exxon, obviously. Devon, Equitable. Those companies have moved pretty far at this point, but Rick sees these as good sort of value plays in the space going forward. Pado, Birchcliff, Tourmaline, Canadian Natural Resources, Arc Energy, and Freehold Royalty. Now that's Rick's list. The second list is again coming from the teams there at Oxbow and Evergreen Golf Call. Atlas Energy Solutions, APA Corporation, ConocoPhillips, Chevron, EOG Resources, Enterprise Products, Energy Transfer, Kinder Morgan. There's an ETF here in Master Limited Partnerships and Energy Infrastructure. The ticker for that one is MLPX. Matador Resources Company, Northern Oil and Gas, Plains GP Holdings, got three more, Petrobras, Shell, and Suncor. So hopefully if you remember nothing else about this workshop here, you've got about 24 companies there to go and explore when you guys get home from here, and they've been pre-screened by some of the smartest people in the business. Okay, so that's oil and gas. If you want to get Rick Rule's latest thinking about why this sector is so interesting, I don't have time to get into it in a lot of depth here, so just go and watch the video that I released yesterday with Rick. It's literally the most recent video on thoughtfulmoney.com. All right, so I want to move on to precious metals now. So real quick, just a show of hands, who here has seen a material jump in your net worth over the past year due to the price action in the precious metals? Okay, so probably about half the room. I'm just curious, and you don't have to do this, but for those of you who raised your hands, how many of you has that change in your net worth been potentially life-changing? And I'm going to raise my hand as part of this too. All right, so congratulations. Like, your prayers have been answered, right? When you bought that stock and you said, or when you bought those metals and said, please God, I really want this to get to X, like, God is delayed. He's over-delivered to you here. So I just want to caution you to not be greedy here at this point. I thought yesterday was very interesting. The day started with a panel of, forgive me for using the term grizzled, Rick, but I think it was the grizzled veterans here of this space, you know, basically saying, look, we had hoped the metals were going to get to here, these prices. We've obviously been really big fans of this and have been evangelizing for it. But when the universe gives you everything you want faster than you expect, probably faster than you deserve, you know, you shouldn't look a gift horse in the mouth, right? You shouldn't tempt fate and ask for even more, right? And so, you know, they're just saying, look, we've seen this movie before. When the price action goes vertical, it doesn't last. And in commodity spaces, but really kind of almost any asset that goes vertical, that price action doesn't resolve by going sideways. You know, it resolves in some sort of pullback here. So basically, they're just saying, look, you know, this might be a time to take some profits. This might be time to exercise a little bit of prudence. And I want to talk about that just a little bit more for a moment. So how many have heard of Daniel Kahneman? He wrote the book, Thinking Fast and Slow. Anyone heard of that title? Okay, yeah. So he was a behavioral economist, and he actually won the Nobel Prize for a theory called prospect theory. And essentially what it says is that just sort of humans being humans, we experience the pain of a loss twice as much as we experience the joy of a gain. And, you know, this is just something we don't think about when, you know, the emotions are running high because we're winning at the poker table, right? We just want more. We just want to keep taking on more risk. But it's really important to keep in mind that actual empirical learning here. So, you know, if you exercise prudence today and you're quote unquote wrong, right? So let's say with silver, let's say you take some of your chips off the table and then silver continues to double from here in a quick period of time. Yeah, you'll have some regret, but you're doing great still, right? If silver were to half from here, my guess is a lot of you are going to feel an awful lot of regret at what you could have done when you had the opportunity but didn't, right? And nobody really appreciates this until you're sitting on the downside of prospect theory. So I just encourage you to just pay attention to the actual empirical data. And really the key question just to ask yourself is, look, what can I live with? Like, what decisions can I make today that I feel like I can live with, especially if the trade goes against me? So obviously, what to do now? So as I mentioned, I interviewed Mark Newton earlier today. He's a complete technician. He has positions in the precious metals. He thinks that they have gotten really dangerously overstretched, but he is a technician. So he says, look, I don't make up my mind. The tape makes up my mind for me. So he said, this is what to look for, because a lot of the question I've been hearing asked a lot this conference here is, when do we know how to take chips off the table? Like, what should we be looking for? This is Mark's answer to that. He says if you're sort of a short-term trader, right, if you're just being a pure speculator here with the price of silver, look for a 3-day low. Wait until silver makes a 3-day low, and that's an initial sign that the trend is maybe starting to break down. So he would say, I personally wouldn't sell. He said, I'm not selling any of my position until at least silver makes a 3-day low. And he said for sort of the average investor, you probably want to look for a 3-week low. Right? You don't necessarily want to get bucked out too early, but look for silver to make a 3-day low. I'm doing that now after having listened to what Mark just said, but I'm also listening really closely to folks like Rick and Ross and Bob, who spoke yesterday. Rick, I tweeted out your comment that the people you've seen the most lose the most money were the people who were caught up in FOMO. Right? And fortunately, that tweet's gone pretty darn viral, so hopefully we're getting a lot of people to at least sort of, check their enthusiasm a little bit here. Gains are only real, I think we're all looking at our portfolios right now and just loving the gains that we're having, right? But we don't really have the gains, right? You don't have the gains until you make them real. I'm not encouraging everybody to sell all your silver, not by any stretch, and in fact, I'm not selling. Rick actually had the cojones to sell 80% of his physical silver. He did it to intelligently de-risk, which I'll talk more about in just a minute. I am actually not selling my silver, my ounces yet of silver or gold, but I am hedging. I am taking on hedges for this, and I believe a lot of the fundamentals that people in this room are talking about that look for, reasons X, Y, or Z, the debt, just the deficit spending, potentially new monetary orders, whatever. We can put all that into the mix. I believe a lot of that. I'm playing for the long game. My silver is not a short-term position per se. That being said, if it goes through a major correction, I don't necessarily want to eat all of it, especially if I don't have to, right? So I could intelligently de-risk by just selling some of my silver. I'm choosing a different route. You choose what's best for you. The point is we have the opportunity here to de-risk when it's looking like this vertical price action, is not going to sustain for all that much longer. So anyways, if you didn't catch it, Rick demonstrated a really good way to de-risk. And again, I'm not saying everybody should just copy what Rick did, but there's plenty of ways to take a little bit off the table. Again, you can just sell some and go to cash. You could put on hedges like I'm doing, and specifically I'm using puts on my portfolio. But what Rick did is he basically said, look, I'm too exposed, or I'm more exposed than I want to be to the price of silver. I've got a bunch of physical silver, so all right, I'm going to sell 80% of that, right? I still think silver could run from here, and I'd like to still have some upside exposure to that. I just don't want to have as much exposure as I had before. So of the proceeds he took off the table, and Rick, correct me if any of this is wrong, half of that you diversified into other assets. And you diversified into other Rick Rule type assets, ones that are not the belle of the ball right now, that are kind of, wallflowers, kind of being ignored by everybody that you think could do pretty well going forward. So just basic diversification. He's already reducing his risk. He's also maybe starting to build exposure to what he thinks the next big play is going to be. He then took the remaining 50% and he put that into the silver miners. So he still has pretty substantial upside to the price of silver. So if he's quote unquote too early by selling and silver vaults higher from here, he's going to participate in a lot of that. He's also, and again, Rick, correct me if I'm wrong on this assumption, but if you look at gold versus the gold miners are kind of doing their job, which is they're supposed to be a levered play on the price of gold. So gold goes up by a certain amount. The gold mining stocks should go up healthily more than that because they're a levered play on gold. If you look at silver, at least on average, if you compare the price of silver to the SIL, ETF, there's no levered effect yet. SIL has the exact same 12-month return as the base metal for silver does. So I think again, feel free to correct me if I'm wrong here, Rick, I think a certain part of Rick's decision is saying, hey, look, I actually think the silver miners have not yet had their catch-up moment yet, where they fully come into their own as a levered play of silver. So not only is he maintaining exposure to the silver price, but he's got that additional potential octane boost in the tank if the silver miners actually do step into their true nature there. So anyways, what Rick has done is basically still preserve pretty big upside to silver, but he's materially de-risked his portfolio versus where it was before. So again, I'm not saying that you should blindly copy that. I'm just saying there are many different potential ways to do this. And if you're sitting here thinking, okay, but I'm not sure which way is best for me, those of you who watch Thoughtful Money know that I think for a lot of people, they'll listen to the very smart experts I have and say, gosh, I'd like to act on that advice. I just don't know enough to feel confident that I'm going to pick the right way for me. That's why I have these financial advisors that I refer people to, and you can talk to them for free, and there's no pressure to work with them or expectation to work with them. It's literally just a free service they offer. So if you want to entertain talking to a financial advisory firm that's experienced in investing in commodities and experienced in hedging techniques or de-risking techniques, highly recommend you talk to them. Now, you don't need to talk to my guys. Just talk to somebody who's good. And if you've got a good financial advisor already servicing you in that, great. Just make the most of that relationship. But if you don't have one, just go fill out the very short form at thoughtfulmoney.com, and you can go talk to one of the advisors that are on Thoughtful Money and just say, hey, look, I saw him at a conference. I don't necessarily want to be anyone's client yet. I'm just trying to think through, here are the details of my position. What ways would you think would make the most sense for me to protect against a potential material pullback in the precious metals? And they'll tell you what they think. So it's just free advice. Highly recommend anybody who wants to take advantage of that does. All right. Lastly, like I said, it's in my opinion and that of many of the folks I interview, it's going to be a year of cross currents and increased volatility. It's really interesting. So. You talk to folks like Lacey Hunt, very smart folks like Lacey Hunt, David Rosenberg, who's here at the conference, or Ed Dowd, and they're all pretty much warning investors that 2025 is probably not going to be a fun year for investors. They're generally predicting a decline in the markets, maybe a lot of economic turbulence in the interim. Michael Howell, the liquidity czar, Mr. Liquidity, he was the first guy that I talked to who in October of 2022 said, hey, it's time to go long. The global liquidity cycle has troughed, and we've got a couple years of rising liquidity ahead of us. He was the first guy to correctly predict the turn in the markets at a point where everybody was 100% confident we were going into recession. Well, now Michael's saying the liquidity cycle has peaked. Right, so he expects that 2026, not necessarily going to be a hugely down year, but it's going to be a very disappointing year for investors, particularly investors who've gotten accustomed over the past 3 years to 20% returns year after year after year. And just statistically, forgetting about your macro thesis or anything like that, 3 back-to-back years of 20% gains in the market is very statistically improbable, but we've had it. Right, the odds of getting a 4th one in a row, just statistically, extremely low. Right, so again, I'm not predicting doom and gloom for the markets. I'm just saying don't go into this year expecting this to be yet another banner year in the markets. Even Fundstrat is predicting this. So again, I talked to Mark Newton today. I mean, Tom Lee's firm, the uber bull of the uber bullish analysts that are out there, Mark actually is predicting that the S&P could be down 15 to 20% by the end of this year. So basically what I'm saying is just be ready for a year that might be a little bit rockier than what we've been used to. So what to do about it, right? So get a couple of bits of advice on that. One is, in years like this, you can still have great outperformance. You just have to be actively managing your funds, not passively managing your funds. The hyperscalers, the big tech AI companies that have been driving everything, if you look at their price action, they've pretty much gone sideways from October. I mean, it really does look like that industry could be peaking out here, and we're definitely seeing capital rotations into other sectors, thankfully to most of us, commodities right now. So if that continues, it's going to be really hard for the S&P to put in much of a positive year if the hyperscalers go down from here. Right? So you want to make sure that you're riding the volatility here. So you want to make sure you position yourself where capital is rotating. Amongst a lot of folks I talk about, yes, commodities is one of them, but consumer staples, utilities, international markets, and especially in the commodity sector, more and more people, like I said, are coming to equity. You may want to raise some cash as well. Again, it never hurts going into a volatile year just to give yourself a little bit of cash cushion. So when prices go down, you've got dry powder to deploy. Hedging, again, it's a big thing I like to recommend, or I like to at least tell people to consider. And again, if you want to talk to one of the experts we have about hedging, they're happy to answer any of your questions. And I'll end with a sports analogy here. So offense is great. You needed to put points on the board, right? We've got a really good offensive lineup right now in the commodity space, but it's defense that wins championships. You talk to any NFL veteran, they tell you it's defense that matters at the end of the day, especially if you're looking to go and win the Super Bowl. I want to encourage you to think the same thing about your portfolio. Enjoy the gains, be grateful for them, but don't get complacent. Make sure you're playing defense while you're playing offense. And with that, I will thank you all because my time is up, and I'll be outside if anybody wants to talk.